All attendees are in listen-only mode.
G'day everybody, welcome back to the Ask the Expert webinar series, and welcome to some new faces. Just a quick recap on what this webinar series is about. There's a spot of humour, certainly a market update, and some learning. So I try and encapsulate all that in a brief presentation, but really mostly it's about your questions. So I've had a couple of questions sent through prior to the webinar, so I'll deal with those at the end, but happy to take questions. The only thing that I really can't do in this 4 and 20 great degree is really address individual stock questions and recommendations, because it's public forum, and all of the appropriate disclaimers and reading of FSGs and all those sort of things that are required under the regulations haven't taken place. I will address one stock today though, because I'll address it in general terms because I've had a specific question on it, and I just happen to be doing some research on that stock as it was. But as a general rule, I'm just not in a position to do that. So let's have a spot of humour to start with, and I found a couple of cartoons that really appealed to my sense of humour. I hope you like them. This first one is obviously having a bit of a crack at Bob Brown, which was interesting, the 100th anniversary of the Titanic, and there's the ALP and Greens alliance sinking on basically hitting the carbon tax iceberg. And Bob Brown's there in a little rowing boat saying, "I'd be feeling green until the day I die, if not for a long time after." So yeah, some pretty clever people around. And this is another one. Craig Thompson affair seems to come and go in the media, and we've got Slow Work Australia taking an awful long time to come up with nothing. So some clever political cartoonists in this country. Just a reminder that this is general advice only, and obviously I have no idea what your investment objectives might be, so any information that you get from these webinar series, you certainly need to consider your own individual circumstances. Let's do a quick global update. Now, bond yields and currencies are really the most important game in town, and really what the share market does is really a function of what's happening particularly in the bond market, because it's finances around the world these days is one large game of competition, and funds are constantly looking for the home where they're best treated, and funds in general have been looking like they're coming out of the bond market and therefore going either into commodities or into the stock market. And as money comes out of the bond market, then yields will tend to rise. So that, in other words, the official government interest rate. Now, they've started rising again in Europe, which is not a good sign, but have eased back in America to a degree. So we're getting a real mixed picture on bond yields at the moment. But I guess the real fear around the world is in Europe, and everyone's constantly watching Spanish and Italian bond yields now that things have settled down in Greece. Seems everyone has to have something to worry about these days. And we'll take a look at that 30-year bond yield in America in just a minute, and I think I've got a slide here on the Italian 10-year yield. Now, the S&P is in correction mode, and if you didn't see the weekend update, I did. I'll just cover that off again. So it was overbought considerably since the early part of this year, and we were always going to get some kind of correction. We had one or two little cracks at it which didn't follow through, but this one looks like it'll probably be have a little bit more substance to it, but it's still really pretty mild to my way of thinking. And the support levels that I'm looking at are 1320 and 1340 are the likely support areas. On the upside, 1440 should provide some resistance, and if it breaks through there, then I think we've probably got a very, very strong market on our hands. So at the moment, the price is in the lower half of that band, so we just need to see how it performs over the next week or two. Here's the Italian 10-year yields that got up above 7% in November and December when the fear level was pretty high. You can see they fell very sharply from 7 back to 5 when the ECB basically started throwing money around like there's no tomorrow. But the interesting thing is here that only a handful of weeks after they handed out their last $500 billion, that interest rates have started spiking again, and in Spain they're up around about the 6% mark, which is not where you really want them to be. So there's still some issues in Europe, but stock markets really, to my mind, are focused a lot more on America, and I just don't see anything dramatic happening in the near term. There's just not the signs of it in in all the market indicators that I look at. Now, China's obviously really important, and there's been a lot of debate of late about whether China is a soft landing or whether it's going to be a hard landing. There's no real evidence at the moment that China's going to have a hard landing, either in any of the economic data or in fact in any of the stock markets, because if there was a real expectation that China was going to have a hard landing in terms of a property crash and a real slowdown in their manufacturing, then we'd be seeing more of that in stock prices. So to my mind, all the signs that I look at suggest that China is probably going to be okay. And you've got to remember, I mean, people were getting a little bit anxious about the fact that China's GDP came in last week at 8.1 instead of the expected 8.4, but you've got to remember that it's 8.1% of a much bigger economy than everyone was ecstatic about, let's say 3 years ago when it was 11%. So in actual fact, the amount of activity going on is really still quite buoyant. Now the ASX index, it's just been so disappointing for probably 2 years now. We've had a false breakout in the last couple of weeks. It's fallen back into the trading range, which is never a good sign. In fact, if you're looking to short the index, that retrace back into the trading range was a good point to basically get short the Aussie index. Looking at the Small Ordinaries Index, the XSO, to me, it's still in consolidation phase. It still looks fine. I would expect that we would have seen a much sharper move down in small resource stocks if this correction was going to be anything other than pretty mild. Small cap energy stocks really remain the stars of the show, and we're also starting to see some attention directed towards graphite in much the same way that rare earths did a couple of years ago. So that's really quite interesting. And rare earth stocks absolutely took off like a rocket about 2 years ago. We saw stocks going up by 5 and 10-fold very quickly. I don't know that people are going to get that excited about graphite. It's not really that sexy, but I think there certainly is some increasing interest. And the fundamentals behind graphite are really quite strong. There's a very good growth fundamental curve behind that. Let's have a look at copper. It's broken its trading range to the downside, so that's not a particularly great sign there either. So we really want to see copper regain $3.80 a pound fairly soon. Otherwise, you're going to see the sentiment towards the mining resource sector start to take a bit of a downturn, I think. And oil still showing great strength at this point in time, but it's really interesting. You would expect that there would be some significant correlation between the price of large oil stocks and the price of oil, but it's actually not that strong when you look at it over the last 3 to 5 years, and you look at it with some reasonable statistical analysis. It's not that strong at all. So it doesn't necessarily mean that we're going to see the Woodsides and the AWEs and the Beach Petroleums and those sort of stocks, Santos, necessarily doing really well. In fact, Woodside's been pretty disappointing. Now, let's just have a look at a few charts before we go and do a quick spot of learning. Let's have a look first of all at the S&P 500 index. So to my mind, we're getting we've had along the way since the move that started at towards the end of December, we had a small correction which occurred in early March. It was basically three days down, and then the market started going up again. We then got 3 mild days down, went up another day, then so that was then a shorter run. We then got 3 days down, we got 2 days up, but you can see how the peaks are getting, or the runs between the peaks is getting shorter and shorter, so clearly running out of momentum. So I think now what we're going to get is a correction of this bigger move. So we're now going to correct this move from the 20th of December to the 2nd of April. Now, looking for support around about the 1340 mark. You'll notice I've got a pretty busy chart here with a number of different technical levels on it, but 1340 to 1320 to me are the support areas that I'd be looking for. And I would expect that this will retrace in an ABC pattern, because that's just typical of crowd behaviour. You get an initial sell-off, you get a couple of days up because people are buying the dips, the selling hasn't finished, so you then get a third leg down, which is what I've shown here, and I would expect that if we do hold support at those 2 levels I mentioned, you can see the RSI here will be getting down pretty close to oversold at that point, and I would then expect that would then clear the way for the index to move up higher, because I'm not seeing anything that suggests to me that this is a market top. I did a fairly extensive run through that with members the week before last in our monthly session, and yeah, just not seeing the signs of a market top. I think this is just a correction, which is pretty normal. So I would then expect a run towards 1440, which is basically, you can see a top from back here in May of 2008. Now that is no guarantee, and that's no prediction, it's merely a structure. So it means that if we watch the market around the 1340 area or the 1320 area, we look for signs of support, we look for signs of reversal, then that's the way that you should use this, not as a predictive tool that anything will happen, because if you do that, you tend to get yourself into a bit of trouble. So that's the S&P. Let's have a look at the US 30-year Treasury bond yield. Some of you would have seen this before. We've had a blip in October. We had a more sustained blip this time that looked like it may go on with it, but just in the last week the Fed has managed to do whatever it is that they do, and has managed to keep the lid on yields, get bond prices pushing up again, and has cooled things off in the bond market. Let's have a look at the XJO, which is our ASX 200, and you can see that we had a key resistance level of 43.50. We'd addressed that 9 times over the space of about 3 or 4 months. We had a little break above it on the 2nd of April, where the market reached a high of 43.77. All the commentators were all patting themselves on the back and saying we're now on the way to 4,500 and above, and it only lasted a couple of hours, turned back around again, closed on the low on that day, as you can probably see, and then very promptly re-entered the range. Now, we also appear to be forming an ABC pattern here, because it'll almost certainly follow the US. So there's our A leg to the downside. That's the initial selling. Then we get the little blip with the people who are buying the dips, and I would expect that we're probably just starting into this phase now. So this could take another week, maybe 2 weeks to play out, would be fairly typical, and I'm probably looking somewhere around between 4,100 and 4,200 for signs of a reversal. But look, in the Australian market, frankly, I don't follow the index very much, because it's really just a reflection of about the top 6 or 8 stocks, so it's not really representative of the market. So that's why I always follow the S&P to a much greater extent. Okay, now just a little bit of learning I thought I'd pass over today. the tendency with newer traders is to focus on stocks, but there are several questions you've got to ask yourself before you focus on stocks. And the two most important things are, how much exposure should I have for the current conditions? In other words, how much cash should I be holding, and how much open exposure should I have, because the odds at the moment are that we're going to get some mild downside, so therefore you don't really need to get out of the way in terms of your existing portfolio. You could sit through it, but what you want to do is to have you want to have a reasonable amount of cash when this correction is completed in a week or two, because there'll be some fabulous buys. So it's really more about taking advantage of that opportunity than anything else. So there's a question: how much exposure for the current conditions? And that's something that that I always keep members very well informed on. And the second question is, what balance should you have between your long and short positions? Now, if you're not a big short seller and you want to hold some long positions, it's still pretty helpful to have a bit of short exposure just as a hedge, so that psychologically it's a little bit easier if we get a couple of sharp days down in the US and our market might fall 60, 80, 100 points. It's just psychologically easier to have some shorts in there that are doing well also. Now, once you've addressed those two questions, you can then get down to looking at some stock-specific questions. Things like, is this a sector in favour? As we've seen of late, large cap stocks are effectively doing nothing. BHP and the banks have been tracking sideways for seems like forever, and all the action's been in the small cap area, but only in part of the small cap area. The sentiment towards gold stocks has been amazingly weak. The sentiment towards gas stocks, so I'm talking about gold producers, which are high quality businesses if you're selecting the right ones. So they've been reasonably weak, and the sentiment towards gas stocks, many of which are just complete speculative punts, has actually been quite amazing. So despite the fundamentals, if you wanted to make money in the last 3 months, there was only one place to do it, and that was in gas stocks. So it's pointless being in other areas of the market when you really need to be in the hottest sector. So you certainly need to discover what sector's in favour. And then, of course, the next question down in this cascade of thought process is to look at what is a low-risk entry point. And that's really something that that is pretty challenging for a new trader to pick up on, because there's just so much to learn and so much to interpret in the stock market. You really do need to get a lot of assistance with that in the early days, so that over time you can start to learn yourself what a low-risk entry point looks like. Because there isn't really a hard and fast formula. It's really a matter of interpretation and, to a degree, a bit of a sense of the market, and that just requires that you have got to be in there for quite a number of years. You have to have gone through quite a few market cycles, just so that you can experience different kinds of market conditions. The next really important question is, where do I exit if I get it wrong? And if you're batting better than 60% successful trades, then you're doing really, really well. So you've got to have the expectation that possibly 40% of your trades aren't going to work out. And the idea is that you need to get out at a predetermined point and absolutely limit your losses to something that's comfortable. And then, of course, the final question is, how will I take my profit if the trade does go in my favour and head in the right direction? It's really not good enough to think that you'll figure that out as you go along. You really need to know those two exit points before you even start the trade. And if you're not in that mode, then it's going to be really, really difficult for you to have a repeatable and consistently profitable trading system. Okay, that's all I wanted to cover at this stage. So I'll open up. I do have a couple of questions, but I'll throw it open to other questions. Okay, so the first one is, will there be an upside to Aussie uranium stocks in the near term? Yeah, it's a really good question. Uranium, as everybody knows, has been out of favour for some time. It was not helped at all by what happened in Fukushima. I think the reality is that uranium is going to remain a part of the energy mix. It's not going to go away soon, but certainly it's been dampened down. There's always been a key date in 2013, which is when the Russian demobilization of their warheads and that agreement that they had with the West to sell that nuclear material expires. I think you'll find that Russia will certainly stop supplying the West. They'll be looking after their own needs, so that's certainly going to take an element of supply out of the market. My understanding from what I've read, and I'm certainly not as much of a, or I'm not as knowledgeable on uranium as I am on, say, gold or copper. My understanding is that there are going to be some significant shortages, and one of the key things with uranium is that the major uranium buyers have to have absolute certainty of supply. You know, you can't start up a uranium nuclear power plant and not have absolute certainty of supply, and then have to, you know, shut it down at some point. So there are going to be long-term contracts put in place which are going to be good for the larger uranium stocks. It's my understanding that a lot of Australian uranium stocks, the little guys, are never ever going to see the light of day. So my strong recommendation to you would be to stick with the guys that have already proven they've got the bigger deposits, because there's going to be a heap of little guys that aren't going to be able to raise the cash. In fact, most of them are going to struggle to raise the cash. I think the ones that are going to go are the ones that have the bigger deposits and are going to get support from some of the really big international players like Cameco, and there's another European one whose name just escapes me at the moment. But yeah, so hopefully that answer helps. So I'm not seeing anything in uranium stocks in the near term that gets me particularly excited. I certainly don't think there's a sentiment shift like we've seen in gas stocks of late, like we saw in rare earths a couple of years ago. I'm not seeing any of that. There might be some stock-specific advances in uranium, but I'm not seeing a sector-wide push yet looking across the charts that I do. And I do a scan every day picking up stocks that are moving, and there's virtually no, I can't remember the last time I saw a uranium stock that came up on a scan, so there's just really not much interest in them at the moment. Okay, next question is, how do I see upside on Aussie stocks with a strong Aussie dollar? The strong Aussie dollar certainly affects the larger cap stocks. There's no question about that, because the larger cap stocks move on the basis of overseas money coming into them. You know, we don't really determine the price of our large cap stocks. And so the Aussie dollar is an issue, because for an overseas investor, he's having to pay more than he did when the Aussie dollar was 90 cents. So that's certainly an issue. But when it comes to the sort of stocks that have been providing profits this year, the small cap stocks, I don't think it's an issue. I don't think it's an issue at all. I think there's much bigger things there. Now I'll just deal with one of the questions, and as I said, it's going to be incredibly rare that I actually address a question on a specific stock because of the licensing regulations. But I will address this question because I just happen to be researching this stock. So it's an Australian oil and gas stock called Jaca Resources. They've got a focus on Africa. They do have some Australian permits in the Carnarvon Basin off Exmouth. They've got a joint venture there with a company called Rialto Energy, and I think Apache Apache Energy is also the major partner and the operator of those permits, but my understanding is they're not drilling there yet. The main interest is really coming from their East Africa areas. They're in two areas, Nigeria and Tunisia. The Tunisia, I think they'll be drilling around about October. Nigeria is the one that is really getting people a little bit excited, but the little bit that I do know of it is that there's potentially a lot of hydrocarbon there. This project has been essentially de-risked both technically and fundamentally. And I have seen some analyst reports, not that I believe everything that analysts write, but I have seen some analyst reports that would value that material in their Nigeria operation alone at probably double the current market cap. Now that does not mean the price goes up to reflect it. Markets can be irrational for an insanely long period of time. You've only got to look at some of the really good gold producers now that have been trading at what I would consider to be incredibly cheap levels for quite some time. So just because an analyst reckons that one of their projects is worth double the current share price doesn't mean anything at all. The thing to look for, and there's obviously when market conditions are very buoyant, oil and gas stocks are getting punted up all over the place, and inevitably towards the end of the run, the really low quality stocks are the ones that start getting punted, and they're the ones that when the music stops, you can wake up one morning and the price is down by 30%, and you've got nowhere to go. You've got no opportunity to get out. So if you're relatively new to the market, just keep that in mind. Don't get carried away, because there will be a morning where the really speculative rubbish gets absolutely belted, and you'll wonder what hit you. And if you've been making profits in the last few months, I've seen new traders give back 2 or 3 months' profit basically in a day. It's gone. So just take care. So the things that I look for are primarily with these sort of stocks, primarily a strong management team, and a management team that's got a really good track record of discovery and delivery of projects. So in the case of this stock, the management team is really quite strong. If you have a look at their background on their website, there's a lot of very appropriate experience. These guys have discovered in this East Africa area before. Some of them were associated with a stock called Hardman Resources that got taken over 2 or 3 years ago. So these guys have certainly got the background that you want to see. The next thing after strong management is that you want to see quality assets. Not just blue sky and maybe some hype on some stock forums. You want to see quality assets. Now these guys certainly, in terms of Nigeria, have got what I would consider lower risk. That doesn't mean low risk, but lower risk, because you've got to remember oil and gas drilling is by and large a pretty risky. It's the risky end of the spectrum. But relatively speaking, I think the Nigeria project is lower risk and offers near-term cash flow. You also want to see some blue sky potential as well in these stocks. That's really important, because that's what can get everybody really excited about what might be drilled in the next 6 months or 12 months. The next thing that you want to see, so strong management is 1, quality assets is 2. The third thing you want to see is them in a financial position where they can complete the drilling program. And in this case, Jaca Resources, they've got 13 million in cash and no debt, so they're in a good position. The market capitalisation of this stock, I think from memory, is about 45 million. So if you subtract the 13 million in cash, then you're only paying about $30 million for all of the assets that they currently sit on. They're fully funded through their 2012 drilling program, which is good to see. So they've just done a recent capital raising, so they've really got no reason to be raising more capital shortly. So that's the third one. And the fourth one, from my perspective, particularly when it's out of Australia, is you want to look at the geopolitical risk. Now, Nigeria, Tunisia, they're not that bad, but they're certainly not Australia. So you've got to remember that there certainly are some political risks associated with that area. So they're my thoughts on Jaca Resources. Let's just have a look at the chart. Sorry, I had the wrong code. It's JKA. Okay, so first of all, we take a look on a weekly chart view. You can see that the share price has previously been up as high as 24. It hasn't been listed all that long. Price backed off to about 5 cents during last year, and we're now getting a pretty good advance. So the low was in July last year. We've had a good advance. Got up to 13 at the start of March, and has now advanced on to 21 cents. You'll notice that we've got quite a good concentration of higher volumes, which is obviously what you want to see. So from a technical point of view, there is a good setup. Now the question is, where is the specific entry price? I'll have to leave that. I can't go into any more detail because that's just getting too close to providing recommendations. But certainly in that setup, both fundamentally and technically, there is a stock that's well worth considering. But there are the key questions of where's the entry price, where's my exit price if I get it wrong, and importantly, if it does go in my favour, how am I actually going to deal with the profit side of things? Where am I going to take profit? What's the technique that I'm going to use? Okay, now I've got a question here from an existing member of Specialist Share about a specific stock, so I'm sorry I can't address that for obvious reasons. But I'm very, very happy to address that question if you wish to put it back to us via the normal channels through email. Very, very happy to address that question. Also, too, through the other forums that we've got. Okay, now the next question is, how do I find which graphite stocks to buy? That's a good question. I guess I'm just kind of aware of them. If you just Google Australian graphite stocks, and that should throw up some options for you. I've not done that, but that should pretty much tell you what you want to know. There's not going to be a lot of them. You're not going to have much of a selection, and bear in mind that that these stocks are relatively early stage. So these are higher risk, but I'm just starting to see the sector as a whole is one that it just seems to be getting a little bit more interest now. Now the other question that I've got is if I'm new to trading, how long does it take to become a good trader? The answer to that depends on a number of factors. It depends on how hard you want to work at upskilling yourself. Perhaps I'll just start with what you do need to become a good trader. You obviously need a good, robust trading plan that's been proven to be effective. But even if someone gave you one, it's not really going to help you become a trader. The main thing that you need to learn is self-discipline and trust in the process that you're fulfilling, and trust in your ability to be able to execute. And the only way that you can build that trust is over time. There is no fast way to becoming a good trader. In my view, if you get a good information source and you get a good trading coach, then you can get a pretty good start, and you can have a real streamlined process. But in terms of becoming independent and consistently profitable, you really need to be thinking about 2 to 3 years. And if you're thinking any less than that, then you're probably kidding yourself, because you've got a whole bag of mental baggage that makes it harder for you to learn how to trade. And that's the hardest thing for most new traders, is to be able to consistently do the right thing when the media and the people you work with and your internal voices in your head are screaming at you to do exactly the wrong thing. And the only way to deal with that is just over time. You've just got to repeat and repeat and repeat things that are effective. And for that, to my mind, 99% of people need a coach to help them with that, because it's just a bit too challenging to do without it. Okay, well, there don't appear to be any other questions at this stage. So thanks for your attendance and contribution, and we'll see you again next Monday. Cheers.